Dear viewers, welcome to the another episode of Expert Speaks. Many of the NRIs who are our audiences have a feeling that NRIs are getting taxed in a different way. They are not treated on par with the resident Indians. They are at a confusion how much taxes NRIs have to pay, when they should pay, how much they should pay. All these doubts, confusions is prevailing in the minds of NRI community. In this episode, we are going to bring more information on that. I have requested my eminent faculty member, Mr. Sriram Rao, chartered accountant, to take you through the different provisions of the law. Are you really being differentiated out, or you are same as anybody else? This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about the subject of today, how the NRI taxation differs from the taxation which is applicable to the resident Indians, I have requested my popular and eminent faculty member, Chartered Accountant Sriram Rao. Chartered Accountant Sriram Rao is very popular on this channel. He has solved many of the problems that were there in your mind. He has given his views, his points, and given a very, very clear understanding of various aspects of law, income tax, FEMA law, etc. on this channel. He is a person who is a practicing chartered accountant. He has clientele from almost all parts of the globe. He has solved many of the tax queries and the tax problems of the NRI community. Welcome to this episode, Mr. Sriram Rao.
Thank you.
Sriram, NRI community has lots of confusion in their mind. You have done lots of videos in the past. It's obvious not everyone has seen the video. Again, I have collated a lot of questions that they have asked in the comment section, and I'm going to ask you in this episode. This episode is all about how the taxation of NRIs is different or similar to the resident Indians. To start with, please tell me which income the NRIs have to pay tax and which income they don't need to pay taxes. Is there a differentiation between the resident Indians versus the NRIs? Over to you, Sriram.
One finer point here everyone should know about is only the income will attract tax in India. Okay, not all money what one receives is in the form of income. Only the income, and that too the income which is defined under Income Tax Act will attract tax in India. So again, there will be certain points like in whose hands and what type of income, where it is earned, it will attract tax in India. All those questions will come into picture. Now, in the hands of resident and ordinarily resident, I would refer them as ROR. In their hands, all the incomes earned, whether in India or outside India, everything will attract tax. Whereas in the hands of non-residents, only the incomes which are sourced out of India will attract tax in India. That means any income which is accrued or arisen in India or income which is received in India, they are called as sourced incomes in India. Only those incomes will attract tax in India. So, first of all, it should be an income and it should be sourced out of India so that the income will attract tax in India in the hands of non-resident.
Sriram, if I heard you correct, the taxation for residents as well as non-resident remains similar. The only difference is in case of non-residents or in case of residents not ordinarily resident, their income outside of India is tax-free in India, whereas all the incomes that is generated in India, whether it is for a resident Indian, whether it is for a non-resident Indian, which includes OCIs, as well as people who are living in India on RNOR status, is taxable in India. Is my understanding correct?
Yes. Now, as you rightly said, all the incomes earned outside of India in the hands of non-resident, it will not attract tax in India. Similarly, in the hands of RNOR, this is a special category, applicable, as many of us, our audience would know, that in the hands of RNOR, all the incomes which is accrued or arisen in India will attract tax in India. However, all the incomes which is earned or accrued or arisen outside of India will not attract tax. However, with the exception that any active income from business or profession, that will attract tax in India in the hands of RNOR. All the passive incomes like interest, dividend, capital gains earned outside of India will not attract tax in the hands of RNOR.
Mr. Sriram Rao, It's quite common knowledge that government, while filing tax returns, have given several exemptions under several clauses, ATC, ATD, etc., etc., etc. Now, is there a difference in the threshold levels, or is there a discrimination for NRIs to make a claim against these provisions?
As of now, there is no discrimination or differences in respect of deductions from the gross total income, a non-resident which can be claimed by a non-resident and a resident. All the deductions like LIC, life insurance premium payment, or say PPF investment payment, whichever is eligible for non-resident to be invested, and they are also in compliant with those provisions, are definitely eligible to be claimed as deductions. Okay, in the eligibility also there will not be much of a differentiation. However, certain investment schemes are not applicable to non-resident. That's why those non-resident cannot invest them. Thereby, they are not eligible to claim. If they are eligible to invest, then they are definitely allowed under the Income Tax Act to be claimed as deductions under respective sections under from the income what they declare. There will not be any differentiation from the point of view of income tax per se.
You mean to say schemes like PPF, freshly the NRIs cannot invest, whereas
Correct.
somebody who is a resident Indian, he can start a PPF scheme.
Yes.
So wherever the law says as an NRI you cannot invest in that, you are not eligible for it. But
Yes.
as long as the law permits you to invest in those schemes, whatever the benefits given in the income tax law, it is same for resident as well as NRI.
Yes, absolutely.
Mr. Sriram, one doubt that is there in the minds of taxpayers or the NRIs who file tax return is when they file a tax return, how should the basic tax slab should be treated? Is it same again for the resident Indians, and is it same for the NRIs, or are there any specific differences when somebody claims the basic exemptions slab?
As on date, the individual taxpayers, they are having two sets of tax regimes. One is old tax regime and another one is new tax regime. Now, in the old tax regime, all the deductions, exemptions can be claimed, whereas new tax regime is a little more simpler in nature. Now, under old tax regime, the tax slab starts with 2.5 lakhs per annum. From there up to 5 lakh, 5%, and from 5 to 10 lakhs, 20%, 10 lakhs and above is 30%. That tax slab for all the resident as well as the non-resident are same. There is no change in that. However, when it comes to senior citizens or super senior citizens above 60 years or 80 years of age, they are eligible for a little higher slab, like up to 3 lakh no taxes, or up to 5 lakh for super senior citizens there is no taxes. But this scheme of available for senior and super senior citizens, they are applicable only to the resident. If one becomes a non-resident, even though he is age of 80 plus, he will have to apply the tax slab from 2.5 lakh onwards only. He will not be eligible for that higher tax slab which is applicable. Furthermore, under old tax regime, there is there is one more rebate which is available from the taxes which is payable by a person who is having income below 5 lakh rupees. That rebate is about 12,500 per annum. That rebate will not be eligible for non-resident. So this is the difference in old regime as applicable to resident and non-resident. Apart from that, everything is same. However, when it comes to the new tax regime, the government has come up with a new tax regime where there is no differentiation between resident and non-resident, and there is also no differentiation between senior citizen, super senior citizen, etc. And there is also no special rebates which are available. So everybody who is coming under the new tax regime or who wants to opt for the new tax regime, they are assured that their tax rates are similar to what would be applicable otherwise to a resident as such. So this is about the tax slabs which are applicable to resident and non-resident. However, one more finer aspect which I would like to state about these tax slabs is when it comes to non-resident, there are certain incomes which are taxable at special rate of taxes, like long-term capital gain from sale of listed or unlisted equity shares, which are taxable at 10%, or short-term capital gain on sale of equity shares, which are taxable at 15%, or dividend incomes which are taxable at a rate of 20%, etc., those income against those incomes, if they are included in the gross total income, there will not be any applicability of basic slab. So that means even 1 rupee of dividend will attract tax at 20%, and that much of tax outlay will be there. So this is how it is. That's the only difference in slab rates.
Okay, let me check my understanding of what you said.
Yes, sir.
There is a resident Indian. He has no other income, whereas his capital gains tax computed is about 2 lakh rupees.
Correct.
And this 2 lakh rupees can be computed against the basic tax slab, and he need not pay that even 10% which comes under the long term capital gains tax. Is
Yes.
that correct? Right.
Yes,
If it
absolutely.
is a case of an NRI, he has no other income, whereas he has got 2 lakh rupees capital gains to be paid, or 2 lakh capital gains is recorded in his income, then he has to pay applicable capital gains for that 2 lakh, and he cannot claim an exemption against that 2.5 lakh basic tax slab. Is my understanding correct?
Yes, perfect.
Mr. Sriram, during our conversation, you mentioned about special rate of taxes. Is it special rate of taxes only for NRIs? Is it special rate of taxes for resident Indians? Can you little bit give more information on that? There's a bit of confusion there.
No, it's a very good question. See, under the Act, there are special rate of taxes which are applicable both to resident and non-resident alike. So, certain things like long-term capital gain on sale of listed equity share or equity-oriented mutual funds, which are taxable at 10% over and above income of 1 lakh on that slab, or short-term capital gain on sale of listed equity share or equity-oriented funds, which are taxable at 15%, or capital gain on sale of long-term capital gain on sale of immovable properties, etc., which are chargeable to tax at 20% rate of taxes, or lottery income, income from owning and maintaining race horses, etc., which are taxable at 30%, unexplained incomes which are taxable at 60%. The rate of taxes for all these are same for both resident and non-resident. Whereas there are certain other incomes. Say, for example, long-term capital gain on sale of unlisted equity shares. They are also chargeable to tax at 10% in the hands of non-resident. Further, dividend income, royalty income, or fees for technical services, they are chargeable to tax at the rate of 20%. These are all flat rate of taxes. Or say, as you all know, that certain incomes are eligible for payment of taxes at a lower rate as per double taxation avoidance agreement, that is between India and the country in which that person is a resident. If there is a double taxation avoidance agreement, that may provide a special rate of taxes, especially for dividend, interest, or royalty or fees for technical services. Those special rate of taxes are also flat rates. Okay, so under those factors and circumstances, those rate of taxes are specially applicable only to non-resident only. They are not applicable to resident Indian. So this is the only final difference in respect of rate of taxes which is applicable to resident and non-resident, special rate of taxes. Of course, all these special rate of taxes which are taxable at a flat rate would be again increased by surcharge and cess, and surcharge and cess also will be alike for both resident and non-resident. There will not be any difference.
So you are taking this conversation to a different level. So I started this conversation thinking that the government of India does not like NRIs and they charge a higher rate. But you are moving to a different level where you say the residents could be paying a higher level of taxes, but the NRIs, depending on which country they live in and what has gone into the DTA agreement, there are definite chances that you could be charged much lower because of the country where you are living in. That's where you are moving into. Is that correct?
Yes, absolutely. Because see, forget about double taxation avoidance agreement. Now with the Indian Income Tax Act itself, now one thing what I mentioned is unlisted equity shares. If one is having and he is a non-resident, he needs to pay tax only at 10%. Whereas unlisted equity shares, if a resident sells, he has to pay tax at the rate of 20%.
Right.
Okay. Furthermore, some of the cases like dividends, who are having high net worth individuals and they are non-resident, they are supposed to pay tax flat at 20%. Whereas if they are residents, okay, they may come up at the 30% slab rate for that dividend income.
Right.
Of course, another beneficial provision for the as applicable to non-resident.
So I will not be wrong in saying here, every NRI, wherever you are living in, whichever the corner of the world, it makes absolute sense for you to dig into the DTA agreement between the country in which you live with that of India and see what provisions are working out beneficial for you, where you can claim exemptions, where you can get relief. Probably you pay taxes in both the countries, and under DTA you can claim exemptions for the taxes paid in one country if you are supposed to pay taxes in another country. So for NRIs, DTA should become a very popular word, and they must dig into the provisions of double tax avoidance agreement.
Yes, absolutely. I would like to make one more final point here. See, when it comes to double taxation avoidance agreement, in respect of residents, generally they can claim the benefit of double taxation avoidance agreement only to the extent of claiming foreign tax credit here in India. Because in India, they're supposed to pay taxes on global income. And the taxes what they paid outside India, they can claim as a foreign tax credit. Only to that extent, they can avail the benefit of double taxation avoidance agreement in general. However, when it comes to a non-resident, they can avail better benefits than claiming this foreign tax credit, like going for lower taxes or for certain type of income under certain fact and circumstances. Such income may not even attract tax in India. So,
Hmm.
every non-resident should make sure that they try to avail the benefit of double taxation avoidance agreement. Of course, there are certain other compliance requirement. They have to comply with that, and they can avail the benefit of double taxation avoidance agreement by for lower taxes or exemption, etc.
Mr. Sriram, one another area NRI community is up in arms against the tax authorities is the issue of TDS. The problems are multiple here. Number one, ignorance. People think TDS is tax. We have spoken in multiple videos to say that TDS is not tax, it is a preventive taxes. For the benefit of NRI community, I want you to tell today what is the difference that is there for the resident versus NRIs with respect to TDS, right? And if there are any cases where the NRIs need to pay a higher level of TDS, why is it so? What is the rationale behind charging that high TDS? And when somebody pays a TDS, what happens there afterwards? Will they lose this money? Should it be adjusted against the tax? What should be the treatment of it? Please enlighten my audience on this subject.
Yes, the TDS is this tax deducted source. In many countries, they also call it as withholding taxes. So it is nothing but a person who is paying the income to the other. Say A paying the income to B. The A will deduct the taxes at source and pay the net of the amount. This taxes what A has deducted, he will deposit to the account of the exchequer in the name of the B. That is the person who is earned the income. Okay, it is something called as, and then he is supposed to provide them the TDS certificate in Form 16, 16A, 16B, etc. in India. Okay, so this being the case, it is as good as B on his income earned has paid the taxes in advance. Like at source, it has been deducted by the payer of the income. So now this being the case, this is an tax which is paid in advance and can be adjusted against the actual taxes payable at the time of filing the return of income. And if there is any excess TDS deducted, that can be claimed as a refund by that particular person. Okay, and there might be 2, 3, 4 streams of income, and only on 2 streams of income TDS is deducted, whereas the tax is liable to be paid on 3rd or 4th streams of income also. This TDS deducted, which is required to be adjusted against the A and B streams of income, can also be adjusted if it is in excess. Can also be adjusted against the C and D streams of income also. So after that, whatever is the excess TDS, that can be refunded back at the time of filing the after filing the return of income. So this is how the process of TDS goes. Now, wherein comes to the differences between the TDS which can be deducted to a resident payee and a non-resident payee, there are certain differences. However, when the salary income is paid to a resident payee or a non-resident payee, there is no difference. That is absolutely the same provision applicable to both resident and non-resident payees. Now, when it comes to a non-resident payee, the payer has to deduct the taxes at higher rate, or the rate which is applicable for them at special rates, as I mentioned already, or the rate which has been prescribed under the Income Tax Act or double taxation avoidance agreement, which is applicable to that particular stream of income. Now, most of them say that this is kind of higher rate, whatever you pay. Now, as you rightly said, it is kind of difficult for the government to track and catch hold of the non-resident, because they are scattered all parts of the globe. Since that is the case, what they do is deduct at a higher rate. Of course, whatever is excess tax which is being deducted at source can be claimed as a refund by that person while filing the return of income. Of course, the government of India will always pay the refund along with interest as applicable on such refunds.
So it only goes to say that government is also taking a preventive route. If he is a resident Indian, you can freeze his bank account, you can go behind him. He has assets here, he can't escape the law within India. But if you are residing outside of India, implementation can become a tricky issue. To prevent such scenarios, government will take the route that I will collect the TDS at the maximum rate. I do not know what rate you fall into. I do not know how much tax liability you have. Chances are that there could be tax arrears that you need to be paying on some earlier cases which have been left unattended. And I do a TDS, and when you come and file the tax returns, it can be adjusted against that. So it's a preventive taxation. NRI community at this point of time should understand one thing: TDS is not a tax, it's a preventive taxation. Best way is file the taxes every year, square it off. If you have some liabilities, if you don't have, and if it is liable to be returned back to you, government will refund back to you with the interest. So we don't have to be complaining about this. It's something which you have a story to tell. The tax authorities on the other side have a story to tell. At the end of the day, the governments are answerable to the public, which has voted it into power. It's as simple as that. Mr. Sriram Rao, NRIs come back. Now the word RNOR has become slowly more and more popular thanks to all the videos that we have done and education that we have imparted. One critical area where confusion still prevails. I have done multiple videos, exclusive videos on the subject, but still, let me get this answers from you directly here. The status called RNOR. Many people feel RNOR is a state wherein which the NRIs will come back to India. For next 2 years, they do not need to pay taxes on anything. And they are under the belief that the NRI FDs, what they are maintaining, will also not be subjected to taxation. So tell me briefly what points NRIs have to keep in mind and the popular myths which are there around this RNOR status.
First of all, let me elaborate RNOR status. It is resident but not ordinarily resident. That means the word itself says they are resident by default. Okay. And this RNOR status, whatever we have discussed in this video till now about the residents, the same rule applies to RNOR as well. Okay. So they are a subcategory of resident only. Now, apart from this, the question what you asked is from the point of view of interest on NRE, whether that is liable to be taxes in India in the hands of RNOR. Now, it is very, very much important for one to understand that this RNOR status is there only under Income Tax Act. It is not there under Foreign Exchange Management Act. And Foreign Exchange Management Act says that only a non-resident as per Foreign Exchange Management Act can maintain NRE deposit accounts or SB accounts. Now, this is the case where a person coming back to India for a permanent, residency to be in India. So on the date of his arrival for a permanent residency, he will become a resident as per Foreign Exchange Management Act. When they become a resident as per Foreign Exchange Management Act, they are not supposed to maintain NRE account. They are supposed to close all these NRE account and convert them to resident account. The date when they come back to India, from that date itself. Okay. So that being the case, from that date itself, whatever the interest earned by that particular person would attract tax in India, whether he is a resident or a non-resident or an RNOR as per Income Tax Act, that is not the question at all. Because under Income Tax Act, it says specifically that an individual who is eligible to maintain NRE account as per Foreign Exchange Management Act would be eligible for exemption of interest earned from such NRE accounts. If he is not eligible to maintain NRE accounts as per Foreign Exchange Management Act, there will not be any exemption available for such individual, whether that such individual is a resident, not non-resident, or a RNOR. That is not the criteria at all to be verified while taxing NRE interest. This is as clear as that.
So it goes without saying here that an individual could be holding an NRE account as per FEMA law or against the FEMA law. There are a lot of NRIs who come back, don't inform the bank, continue to enjoy the benefit of holding on to NRE account. But you have to remember here is that you are holding these accounts against the provisions of FEMA law. So you are violating the FEMA law. So it will have its consequences if it were to be reported or anything like that to happen. On the other side, the income tax law is very clear, which says if you are holding an NRE account in accordance with the FEMA law, the interest earned is tax free. But if you are holding it against the FEMA law, which you will be during your RNO or if you hold an NRE account, the interest will become automatically taxable. So it is very crystal clear. So you will be taxed for the NRE interest during the RNOR period. The second is you will be unnecessarily at the receiving end of FEMA law. Is my understanding correct, Mr. Sriram Rao?
Yes, absolutely.
Mr. Sriram Rao, thank you very much for your time and for all the answers you have given to my audience regarding the confusions that they had, regarding the grounds that they had that the India is taxing more for the NRIs. After hearing your presentation today, I'm very sure NRI community will feel very relieved that they are not taxed extra and they are treated on par with residents, and probably there are many things which is working in more favorable to the NRIs. Thank you very much for your time and look forward to talking to you with yet another topic in yet another video. Thank you very much, Mr. Sriram.
You're welcome. Thank you.
Dear viewers, hope the episode that I've done today helped you to understand the finer points of difference between the taxation for resident Indians versus non-resident Indians. If it did help you to understand all the finer points of taxation for NRIs, please do give me a thumbs up. If you are a person who is watching my channel for the first time, or if you are yet to subscribe for the channel, please hit that subscribe button and press the bell icon. Do not forget to share these videos with your near and dear ones and friends and relatives and on all the WhatsApp groups on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back next Tuesday with yet another expert talking about yet another useful topic. Till then, stay safe. Jai Bharat.
Press the bell icon for more details and subscribe our channel.